Hi, hello, welcome friends. In continuation with last class, so మనం ఫైనాన్షియల్ ఇన్స్ట్రుమెంట్స్కి సంబంధించి డిస్కషన్ చేస్తున్నాము. సో అందులో డెఫినేషన్స్ కంప్లీటెడ్ అండ్ కాంట్రాక్చువల్ క్యాష్ ఫ్లోస్కి సంబంధించి కంప్లీటెడ్ అండ్ సోలోలీ పేమెంట్ ఫర్ ప్రిన్సిపల్ ఇంట్రెస్ట్ ఆర్ completed. Now we will start with financial assets initial measurement. How can we measure at initially and how can we measure at subsequent measurement? So first of all, we need to see some quick review for understanding. So we will start with some quick review. So in quick review we have the classification and measurement of financial instruments are summarized as so we have seen in first video, that is financial assets means what, financial liability means what is equity. So here the qualifications, for the basis of qualification we need to know about BM test, whether it is to collect contractual cash flows there, and SPPI test we need to see the basis of allocation, and for the FET OCI we need to see that business model test to collect contractual cash flow, and it has a sell also, that is an SPPI test also. FET OPL means that is held for trading, it may be SPPI, that is SPPI or business test fails. So when it is failed for these two, then it will go for the FETPL. It is related to financial assets, and when it is financial liability, amortized cost default criteria will be considered, and whereas FETPL it is L for trading. If it is for L for trading, it will be FETPL, and entities elect FTPL using fair value options. Then basis of allocation will not be there in equity. Next, initial recognition. So for the initial recognition, fair value plus or minus transaction cost. So if it is integrated cost, we need to add. If it is not integrated cost, we should not consider that one. Next, fair value plus or minus transaction cost. So the integration is integral part, we need to consider. If it is not integral, we should not consider. And in FETPL we need to consider only fair value, and after that financial liability, same fair value plus or minus transaction cost at the initial recognition. But whereas the FETPL means here only we have fair value. For equity it will be fair value. Next, subsequent recognition. So subsequent recognition, amortized cost means first initially we will recognize all at fair value only. For subsequent recognition we can go for amortized cost, we can go for OCI, or we can go for the FETPL, that is related. So here financial assets will be classified as amortized cost if the objective is to hold the financial assets. This financial asset is hold for why reason will be to get contractual cash flows, collect contractual cash flows plus contractual terms give rise to cash flows, that is solely payment principal plus interest. Then it will be classified as financial assets at amortized cost. Next, contractual terms give rise to cash flows, that is cash flows they are providing, but cash flows will be solely payment for principal plus interest on the principal amount outstanding. The contractual cash flows must be consistent with basic lending arrangements. So they are providing some basic lending arrangements. The basic lending arrangements may have interest element, and for the interest element we need to consider some time value of money and credit risk and liquidity and profit margin, services or administrative costs, etc. should be considered. And contractual cash flows linked to features such as change in equity or commodity prices would not pass the SPPI test. So because they introduce exposure to risk or volatility, SPPI test will be met if they are prepayment penalty or additional compensation. So we are also discussed that relating to if they are paying prepayment, they will get the discount. If you are paying lately or extended time, they will pay additional compensation also. And an entity may have one of the following model for its debt instruments. For debt instruments like debentures, they may have options. So all to collect contractual cash flows means here they will get the interest amounts quarterly or half yearly or monthly, and hold to collect contractual cash flows and selling financial assets. So sometimes they will sell the financial assets and they will reinvest that assets in market. Sometimes other business model, that is actively buying and selling, so they are doing the business of buying and selling of these debentures. Next, financial assets in debt instruments measured at FETOCI when if it has hold to collect and sell business model sell hold to collect and sell and business model test and SCMPE contractual cash flows test was pass. So when these both are pass and the both they have, that is hold to collect and sell, then the financial assets will be debt instruments will be classified as FETOCI. In respect of financial assets in equity instruments, for equity instruments we need to follow India AS 109 requires all equity instruments to be measured at fair value. All changes in fair value should be recognized in FETPL only. However, NTC can make an irrevocable elevation at initial recognition to classify the instrument as at FEOCI. So such options is available instrument by instrument, that is items by items, and all subsequent changes in fair value being recognized in OCI. Dividend received on equity will be recognized in profit and loss account. If they have any transaction cost, the transaction cost is incremental cost, that is directly attributable to acquisition, issue or disposal of financial instruments. Then we next, so we will start with the what we are stopped. I think it was like anything. I will stop that. So we will start now from where we have stopped. I think up to that one completed. Now we will start with measurement. So in measurement, what is there? So instrument we will measure at initially fair value. So normally transaction price. Here the instrument price of market price, what is there? So instrument at off market terms. So what is the different market terms will be there for similar items? For example, long term loans are receivable that carry no interest, where similar instrument if exchanges between market participants carry interest. Then we will go with that similar rate by considering that similar case. And in aforesaid example, the fair value of long term loans are receivable can be measured at present value of all future cash flows discounted using the prevailing market rate. So for example, holding company given loan to subsidiaries, they are not carrying any interest, but similar companies they have similar one interest rate. Then we need to calculate the all present future all cash flows will be discounted at that rate. And transaction cost. So transaction cost means that wherever we have appointed some agents, we need to pay that commissions, or if advisor is broker fee, delivery fee, whatever that amount they are collecting for doing the transaction, it is known as the transaction price. So here we will see interest measurements, instruments at market terms, instruments at off market terms. So market terms means as per market they are following, instruments at off market means they are not following the market terms. So if it is a market terms, then it is the transaction price, so directly we will consider by blindly. If instruments at off market terms, then we need to determine fair value of that financial instrument. Now we will see, first we will go with the any fair value based on level 1 inputs or valuation technique that use only from data from observable market. So when we are not considering the off that company is not considering off market terms, then we need to calculate the fair value based on level 1 inputs or some observable techniques we need to consider for calculation that fair value. Here the difference, whatever the difference will be there, that fair value and transaction price will be recognized in profit and loss account. And any other basis means difference between the fair value and transaction price recognized as asset and liability. If that meet the definition of assets, or if that meet the definition of liability, then we need to consider as assets or liability. Otherwise we need to recognize in profit and loss account the different amount. Next, here the information was provided, interest income is impairment repayable on demand. So no fixed maturity, if there is no maturity facility, what can we do? And demand deposited, what can we do? So for example, here we will see the question 21 questions. So here the deposit carrying off market terms. So off market terms means they are not considering the market. Now container company, here one company is there, so I will explain simply. So one company is there and they provided container for their customers multiple purpose. So company there and customers will be there, and they providing containers, and the container, this is one container, it will go, container will go, and this container will be returned after the contract period, when of the service contract period between container limited and its complete. So it monthly charges rent for their security deposit that each customer make with container limited for 10,000 per container, and such deposit is refundable. So for sending this container from this customer, the company will take some security deposit of 10,000 rupees. On this they are paying some interest, and it will be refund after the 3 years when service is terminated. Deposit does not carry any interest. So if they are charging, okay, in additionally they are charging monthly charges, so here they are not paying any interest, sorry. So they taken security deposit from this person, and they are also charging monthly charges, so it is the case. So they are not paying any interest on this security deposit, but market rate for 3 years loan 7% will be there for in market sum. So they are not considering a market, so we need to consider now. So firstly answer in the above case, let's see the customer person, this is the person in lessee customer leasing the container, so make interest free deposit which is refundable at the end of 3 years. Now this money, if it lent to third party, if he sent to the third party, he will get the 7% interest. So we need to consider all cash flows, means for the 10,000 amount we need to calculate the future cash flows by discounting the future cash flows. So firstly we need to initially recognize, so amount security deposit amount 10,000 divided by 1 plus 7%, 07, this is related to 3 years, so we will get the 8,163 the security deposit, and for 3 years we need to add the interest portion. So for first differential on the first day, whatever the amount is there, 10,000 minus 8,163, it will become the difference between 8,837. so that the differential on day 1 should be treated as scenario 1 if the fair valuation is determined using level 1 inputs, then other observable input different is recognized in P&L. If it is scenario 2, means if this expenditure meets any assets or liabilities definition, then it will be treated as assets or liabilities. So scenario 2, if that not meet any assets or liability, then it will be treated as expenditure. Now however the security deposit level 1 is not available, therefore in the above case, because they went through off market terms, so the fair valuation is made based on unobservable inputs, and hence applying scenario 2. So is recognized as an asset if it meets the definition. Now since the lessee get to use the container in return for making an interest free deposit plus monthly charges, so what they are paying, one deposit plus monthly charges, the last interest representing day 1 difference between value of deposit and its fair value is likely prepaid lend. So whatever the amount they are paying, it will be treated as prepaid lease rent. So prepaid lease rent, so it is the lease cases, so we will use the ROU, that is ROU assets should be charged off to profit and loss account in a straight line manner as depreciation as per Ind AS 16, that is related to initial measurement and subsequent measurement. In subsequent measurement what will be happen, so in subsequent measurement asset may be, for first time measurement we have go with the fair value only, for subsequent we have option, we can go for the amortized cost, we can go for the OCI, we can go for the FETPL based on the business model test pass or SPPI test passes. So assets will be measured at amortized cost. When asset is measured at amortized cost, they are given some conditions, so what we have seen there, so measure that fair value. Here some interest is there or some dividend is there, so whatever the interest, whatever the dividend, if you get, it will always recognized in P&L. so it is the amount we need to recognize in expense, profit and loss account. So whenever the in question we have seen any interest or dividend, we need to charge off to profit and loss account. Next, if you have any gain or loss, so in subsequent we have 3 options. Now we can go with the FETPI or FETOCI, that is other than equity instruments, or FEOCI equity instruments. So for this interest and dividends we do not have the amortized cost. So gain or loss, If it is FET OCI, if it is realized or unrealized, fair value of gain or loss will be recognized in profit and loss account if you are using, or if it is related to fair value other than equity instruments. So if it is other than equity instrument, it is other than equity. If it is realized gain, then it will charge you to profit and loss account. If it is unrealized gain, we need to charge you to recognize it in OCI. Next, FEOCI equity instruments, if it is realized or unrealized, it will charge you to OCI. So here we need to discuss gain or loss. Gain or loss FET OCI. So we are following FET PL, then whatever recognized or unrealized, realized or unrealized, we need to charge to profit and loss account. If it is FET OCI, if it is FEC OTI and equity instruments, then we need to charge to FET recognized in OCI, whether it is realized or unrealized. FEOCI if other than equity instruments. So if it is realized, we need to charge to profit and loss account. If it is unrealized, we need to charge to FE recognized in OCI. That is, they are provided here some cases. So I will go with the cost is never the best estimate of the fair value for investment is quoted equity instruments. So that we need to calculate fair value. Now question number 22nd. So what is there in 22nd question? So here they provided accounting for transaction cost and initial and subsequent measurement of financial asset measured at a fair value which changes through OCI. So they are using OCI. Now first entity, one entity is there. They have purchased one financial assets for how much? This is 100 rupees. So 100 CUs, and they have paid some commission 2 rupees. So totally what is the amount? 1 or 2 they are recognized, already completed this on the reporting day. And 1 day later the quoted market price of the asset is 100 rupees, and if the asset was sold, commission of 3 rupees would be paid. How would transaction cost would be recorded in the books of accounts? So whatever the amount is there, so this is 100 and this is 2 rupees commission when it is completed the transaction. On the reporting ends 1 day later, the quoted market price was same, so it is same, but this commission will become 3 rupees when if the asset is sold. We are not selling, we are assuming there, if they sell, what they will 3 rupees. So how we will recognize the question? So on the day the entity measure the asset will be 100, that is without regard to the possible commission on sale. So we not consider that is possible commission, and recognize loss of 2 rupees in OCI. So this is first entry, it will become. And if financial asset is measured at FET OCI in accordance with Ind AS 109, the transaction cost amortized to profit and loss account using effective interest method. So we need to amortize that 2 rupees by using effective interest method. So it OCI and this is asset. So 100 rupees will become the asset, that is in balance sheet it is asset. So in PNL downside OCI, this is 2 rupees will be there and it will be recognized, and using the effective interest rate we need to amortize it to profit and loss account. Next, after that, determining the fair value. So question number 23. So in 23 question, what they are provided, one share company is there, company C is there, and financing some loan notes. So given loans, the shareholder of company C provided C with financing in form of loan notes to enable it to acquire investment in subsidiaries. So they are provided some loan notes. The loan notes will be redeemable solely out of dividend received from these subsidiaries and became redeemable only when C has sufficient fund to do so. When C has sufficient fund, they will pay. In the context, sufficient funds refer only to dividend received from subsidiaries. So analyze the initial instruments. So in this case, firstly, loan notes repayable only when C earns the return in the form of dividend from subsidiaries. So here first we need to see C earns return in the form of dividends from subsidiaries, and here C cannot be forced to obtain additional external financing or to liquidate its investment to redeem the shareholders' loan. So consequently, the loan notes are not considered as payable on demand. So when we are giving the option to other person, it is not on demand. Accordingly, loan note shall be initially recognized at fair value. We need to recognize that fair value, that present value of future cash flow. So next, discounted using the market rate. So this discount rate will be based on the fair market rate. We will consider the amount and timing of the expected future cash flows should be determined on the basis of expected dividend flow from subsidiaries. So also valuation would be need to take into account possible earlier repayment principal and corresponding reduction of interest expenses. Next year, since loans are interest free loans, so where interest means bear lower than the market interest, so there will be difference between the nominal value. So there will be difference between the nominal value of the loan and the amount granted and the fair value of initial recognition. So there is some difference will be happen when we are considering this present value of the loan. In the year, because of financing his provided shareholders acting in the capacity of shareholders, the resulting credit should be reflected in equity as shareholders contribution in C's balance sheet. So conversely, in the books of shareholder, the difference between the amount invested, so whatever the amount invested and its fair value will be recognized as underlying relationship between the C shareholders and C limited, it will become the investment amount. So when there is investment, so for shareholders and companies it will become the investment, whatever the different for the initially recognizing amount and fair value amount, the different will become the investment. So next, question number 24. What is there in question number 24? In question number 24, use the cost versus fair value determination for equity instruments. Here Silver Limited is there has made an investment optionally convertible bonds, so OPCI bonds. So one company is there, they are given, they are invested, so company is invested means it became the asset to this company. So investment account debit to cash or bank, they are paid, and these bonds will be invested in bronze. So what is the value? 100 rupees per share, face value will be 100 rupees per share, and Silver Limited has an option to convert these OCPs into equity shares. So this investment will be OCPS, and if they want they may convert to equity here, and they have equity in the ratio of 1:1. If such option is not exercised till end of 9th year, then the shares shall be redeemable at the end of 10th year at premium of 70%. If they are not converted to this case, they will payable by interest, paying adding the premium 20%. So analyze the measurement of this investment in the books of Silver Limited. So silver means who is the person invested. So here the case will be this person is invested in bronze, that is OCPS. So OCPS may convert equity shares 1:1. If they are not converted, they will repayable by adding the 20% premium. Now we need to calculation in the books of this. Yes, so classification assets for financial assets is done based on the two characteristics. One will be what is the contractual cash flows. So we need to see the contractual cash flows. So compromises cash flow, that will be solely payment for principal plus interest we need to consider on principal outstanding. After that, business model, we need to consider the business model of managing financial assets. So whether the company business model is collecting contractual cash flows or not. So BM, that involves realization of both contractual cash flows and sale of financial assets. So in all other cases, the financial assets are measured at FETPL. So we need to consider first what is the base will be there. If the above conditions is not satisfied, then we will directly jump into FETPL. If above conditions are satisfied, we need to see it will be amortized cost or OCI cost. So in the above case, the holder can realize it. So here the holder can realize the return either through he have two options. So one will be he may convert, one he may be redeem. So at the option of that person. So hence it does not indicate contractual cash flow, that solely payment of principal and interest. So here does not have any contract to pay any amount contractually. So therefore such amount shall be carried at fair value to P&L. Accordingly, investment shall be measured at FVTPL periodically with gain or loss recorded in profit and loss account, because they are not getting any amount from up to 9 years or 10 years. So at the end of 10 years they will decide based on the terms of market conditions. The person who has invested, he will see in the market, if the price of that equity shares is high, he will convert that shares. If the price of the equity shares is less, he will redeem the shares. After that, question number 25th. In question number 25th, what is there? So A Limited has made security deposit. So A made some security deposit and whose details are described below. So making necessary accounting entries for accounting of deposit in the first year and last year. So first year, whatever the will be there in the first year, we need to recognize it in fair value. After that, we need to change if we want amortized cost, or we can go for the OCI based on the given information, assuming the market interest rate for deposit for similar period to be 12%. So it may consider as effective interest rates. So deposit will be starting date 1st April 2001 and the date of security deposit finishing will be 31st March 2016. So description will be leases, total lease period. So when we are using leases, whatever the different amount we will consider as ROU or etc etc. If we are there investment means that holding or subsidiary, whatever the different amount we will consider as capital contribution or investment. If you are persons different company and employees, whatever the different amount we will consider as employee expenses. So now here they are telling that lease period will be 5 years, discount rate will be 12% and security deposit will be 10 lakhs and present value of the factor will be 0.567427. So at initially we need to recognize that fair value. So above the security deposit, interest free deposit, lease term will be 10 lakhs and involve collection of contractual cash flows and will be accounted amortized cost. So for that security deposit 10 lakhs, okay, total lease period 5 years and discount rate 12%. So present value will be 0.5674. So initially 10 lakhs into this value, it will become 567427. It was present value of deposit at the beginning 5,67,427 and different amount. So in lease we will consider as prepaid lease amount. So extra amount whatever that they are paid, it will consider as prepaid lease payment at the beginning. So at the time of entering, first we are paying now. So paying means credit what goes out to bank is crediting 10 lakhs and debiting one security deposit, because we are paid amount as a deposit was 5,67,427. Actually we are paid 10 lakhs. We are bifurcating that to one is 5,67,000, one is 4,32,000. How we have got this 5,67,000 means it is present value of the 10 lakhs. So initially the financial assets will be recognized at fair value. So we are converting that asset into fair value. Next, subsequently every annual reporting the interest income shall be accrued. So whatever we have some deposit now, for that deposit at the rate of 12%, this is market rate. So on that market rate amount will be accrued interest income. So security deposit account debit to interest income, and at the end of the 5th year the security deposit accrue, it will become 10 lakhs and total amount security deposit to interest income, it will become 1,07,000 at the end, and deposit amount it will become 10 lakhs and we will get the amount. So whenever amount is receiving, so whatever debit what comes in, so bank account debit to cash security deposit account, that is lease related. And after that 26th question. In 26th question, accounting for assets at FVTPL. Here what they are provided information. So one company is there. So company A Limited is there and they are invested in C Limited, that is equity shares. They are invested on 15th March of amount what will be 10,000 will be the amount, and transaction cost will be 500 rupees will be the transaction cost. So whether we need to add this 500 or whether we need to deduct this amount, we need to consider. So firstly we have 500 will be there, that is cost. So in addition to basic cost 10,000 on 31st March, so we are taken purchase at 15th March, and that is initial date, it will become the initial date. And on 30 March, so this reporting this, the fair value of equity shares was 11,200, and it was become 11,200, and market rate of interest of 10% per annum for 10 years loan. So pass naturalized general entity, analyze the principal and pass. So above investment is equity shares of C Limited. So it is C Limited shares. A Limited was invested. So it does not involve any contractual cash flow. So they are not paying any dividend or interest. If you go for the debenture, they may pay the interest. For equity, there is no liability for paying of the interest in this case. So company has option to pay dividend or not. Based on their profit, they may decide paying dividend or not. And yes, hence does not have contractual clause for that solely payment of principal and interest. So hence this equity share shall be measured at FETPL. So for equity shares you need to consider FETPL. So FETPL also an irrevocable option exists to designate such investment as fair value through OCI income. So firstly we need to add interest. So investment, so we are invested debit, and we are incurred directly related to expenditure means transaction cost 500, and plus bank account, whatever amount goes bank account will be created. So being investment recognized at fair value plus transaction cost initial recognition. Next after that this 500 will be charged to profit and loss account. So profit and loss account debit to transaction cost, being transaction cost incurred on asset method at FETPL transfer to profit and loss account. Next subsequently investment in equity shares of C Limited debited to fair value gain on financial instruments, it will become 1200. So 10,500 is there for 10,000, 10,000 is there. How much it will become? So 10,000 value asset, it was become 11,200. So different amount will be 1,200. So 1,200 will be added to that asset. So investment in equity shares C Limited account debit to fair value gain on financial instruments, fair value, and that fair value gain will be transferred to profit and loss account at the year end. Next question number 27, accounting for assets at FEOCI. So here one company is there. What is the company? Metallic company has invested in Castor Limited. So here also equity limited, equity instruments for 19% stake. So 19% stake they are provided, and significant influence not exercised. So 19% means they will not get the any influence here. And they are also, the investment was made 5 lakh rupees. So amount will be 5 lakhs 10,000 equity shares. And on 30 June 2001 the fair value equity shares is 45. So if we see 10 lakhs means 5 lakhs capital, 5 lakhs divided by 10,000, it will be 50 rupees. Now it will become I think 50 rupees. So 50 rupees, now it was become 40 rupees decreased. So now the company has taken irrevocable option to measure such investment at FETOCI. So they are telling you need to recognize at FETOCI. The company has made an irrevocable option to carry its investment at fair value through FETOCI. So accordingly the investment shall be initially recognized at fair value, and all subsequent fair value gains shall be recognized at FETOCI. So general entries will be, first we are invested means it will become the asset. So investment will increase, investment account debit to cash or bank account because bank amount is going. So 5 lakhs and 5 lakhs. So had the initial entry, so 5 lakhs initial entry, and it was become 4 lakh 50. So now we need to reduce our investment. So for reducing the asset we need to credit that asset. So when asset is decreasing we need to credit, when asset is increasing we need to debit. So here debit, here credit. And fair value loss on equity instrument debit to equity investment in equity shares limited 50,000, and the being the fair value loss recognized in OCI. So it will transfer to fair value reserve for equity instrument to fair value loss on financial instrument. It will shown in profit and loss. We have downside OCI. In here we will consider. And after that, question number 28. What is there in question number 28? In question number 28, they are provided XYZ company is there, and it is incorporated in India, and they are given one loan to wholly owned subsidiary company. What is that wholly owned company? I think it is better to wholly owned subsidiary ABC Limited. They are given how much amount? 10 lakhs. Has interest free loans. So means they are not collecting any interest. They are given 3 scenarios. When loan is repayable on demand, whenever the principal holding company asks, then the subsidiary will need to pay. Or loan is repayable after 3 years, so they are giving time, and they are also giving some market rate, similar market rate, so we will consider that one. And after that, loan is repayable when ABC has the fund. So here the option will be how to this subsidiary, whenever the subsidiary has cash, then they will repay. Whenever the on demanding is the first scenario, and whenever the ABC option, it is third scenario. And in second scenario, given market terms, whatever the transaction, that in separate financial SFS, that is separate financial statement or standard financial statement only affect. In CFS it will not affect any interest or payments, because in interest or payments, one company is paying interest, one company is receiving interest, the net effect of inter group will be set off. So there is no effect on consolidated financial statement. But it is the other country na, because they have any foreign currency changes, it will be accounted as per that. So here first we will see in India AS 109 requires that financial assets and liabilities are recognized in initial recognized at a fair value. So whatever the asset, financial assets, whatever the method we are using for subsequent measurement, but for initial recognition we need to measure at fair value, and we need to adjust the transaction cost if there any cost is there. And in accordance with India AS 113 fair value measurement, the fair value of financial liability, so here the financial liability, it is not equity, so here the fair value financial liability with demand feature will be there, that is demand deposit is not less than the amount payable on demand, will be discounted first day the amount is required to be payable. No, first scenario will be principal, that is holding company may ask whenever they want. So on that case the company has fair value, so here the fair value is equal to cash consideration given, whatever the amount they are given, that is the fair value, because the parent and subsidiary recognize the financial assets and financial liability. The parent will recognize as financial assets and subsidiary will recognize as financial liability, and respectively amount given. And going forward, if there is no interest is accrued on the loan, so they are given in interest free loans. And after repayment, when the company is asking repayment, they need to reverse this entries. So subsidiary reverse the entries in the organization. Next, in scenario 2, what is there? They are provided some after 3 years, and interest rate will be 10%, not for given that holding company, it is for similar market rate. So here similar market rate interest rate was given. Now both parent and subsidiary recognize financial assets and financial liability initially at fair value and initial recognition. The different, if any difference is arised on loan amount, the fair value is treated as equity contribution to the subsidiary. So if it is related to, is there any difference at the time of initial recognition? So we will see in initial recognition. So in initial recognition, if it is related to parent and holding, then it will be recognized as investment or equity or capital contribution. If it is related to leases, it will be considered as that prepaid expenses. If it is related to employee, then it will be considered as employee related expenses cases. Now what is there in here? So here firstly they will recognize the loan to ABC Limited, so it is related to parent company. So parent company is recognized that 10 lakhs will be converted into present value. So how they convert the present value? So they given the percentage na. So for 3 years present value, present value factor 10%, it will become 7 point something it will become. So and 10 lakhs it will become 7 lakhs. This 7 lakhs will be the initial recognition, 7 lakh something. So 7 lakh will be the 7 lakh 51 will be the initial recognition, and difference amount will be considered as investment in a subsidiary or deemed investment or capital contribution, whatever name you want you can take. It is like an investment in subsidiary only. So total amount we are paying bank is 10 lakhs, being loan given to ABC Limited and recognize that fair value. Whatever the accrued interest, so on this 7,51,315 we need to accrue the interest to loan to ABC Limited account to interest income. So you need to recognize the interest income. Loan to ABC Limited debit to interest income 82,645 and loan to ABC Limited to interest income. So 3 years. So for 3 years we need to accrue the interest amount. So how the amount is increasing? 751 and 7 lakhs plus 51 plus 75,000 we will add 8 lakhs something it will come. On that 82,000 it will be calculation, and after that this amount we will add this amount, it will become 90,000 99 lakhs 90,000 something, and on the 10% 90,910. So totally it will become at the end 10 lakhs. So we will that holding company will get back when at the third year. So when getting the amount, bank account debit to loan to ABC Limited. And in subsidiary books, they are taking the loan. So loan from XYZ, that is holding company, and they need to equity portion. So in balance sheet loan is there 7 lakh and equity portion it has 7 lakh 48,000, and different amount will be considered as equity contribution from in holding company, and we need to accrue the interest on this loan amount. So we need to pay the interest up. So we need to accrue that interest entries for 3 years. After that it will loan from XYZ payable debit to bank account. So here present value of loan we will take 10%. The loan will be for 10% 3 years, present value becomes 7,51,315. After that 10% we will add 8,26,446, and after that 10% we are adding 8,26,000. After that 10% it will become 9,09,091, and after that 10% it will become 10 lakhs. In case scenario 2, here the generally loan which is repayable when funds are available, so cannot be stated to be repayable on demand. Rather the entities need to estimate repayment date and determine its measurement accordingly. If they are estimated any payment date, then if we, for example, if it is 3 years, then we follow the scenario B. If they are changed years, 5 years, the present value will be changed for 5 years, and interest accrual will be calculated for 5 years. And in consolidated financial statement there is no change. So to the loan and interest expense will be get eliminated as intergroup transaction in all 3 scenarios. So in the above accounting will not have any impact on CFS. So here the if there is any foreign currency exchange will continue the impact in statement of P&L. Next, now how the financial liabilities will be classified in this case. So if we are going for method at we are method at amortized cost, method at FVTPI if the liabilities meet the held for trading and contingent consideration is recognized by acquirer or designated at fair value through P&L, or other specific methods we need to consider here. So here we will see some questions. So first question, 29th question. What is there in 29th question? Here a company, one company is there, it has purchased some raw materials from, for example, we will take H is the person, and this vendor given price will be 1,000 rupees. So 1,000 will be the fixed price per tunnel, and payment terms will be 45 days credit paid, after which interest of 18% per annum shall be charged. So 18% will be the interest will be charged. If less than 45 days there is no problem. If more than 45 days he will charge the interest amount. So here company he has a liability. Now what can do? Creditor for purchase steel shall be carried at amortized cost, because they are provided time. So when there is a time we need to follow the amortized cost. So fair value of amount payable upon initial recognition plus interest. If payment is delayed. So here the fair valuation upon initial recognition shall be price per ton. The transaction price is represented as fair value. So initially we need to recognize the fair value and subsequently fair value amortized cost. Next question number 30. What is there in 13th question? So here in 13th question they provided that one entity is there. So entity A is there and they are about to purchase one portfolio. They are trying to purchase one fixed rate asset. So fixed rate assets that will be financed by fixed rate debentures. So it may be treated as debentures only. Both financial assets and financial liabilities are subject to same interest rate, and so for purchasing these assets they are going for fixed rate debentures. Now this financial asset financial liability subject to same interest rate of risk that give rise to opposite change in fair value that tend to offset each other. Now we need to provide the comment. So firstly fixed rate assets, what we are taking fixed rate asset fixed rate debentures. So fixed rate assets provide contractual cash flows here. So contractual cash flows will be provided when we have financial assets based on the business model of the entity, because it is related to debentures, and such fixed rate assets may be classified as amortized cost. Now when we are purchasing one fixed rate asset means we will get the interest, so it will become the contractual cash flow. So it will be classified as amortized cost if entity collect contractual cash flow, or fair value through OCI, that is if entity manage through collecting contractual flows and sell financial source. So when will we classify as amortized cost? If it has allows contractual cash flows, if it has contractual cash flows and entity is managing that contractual cash flows by selling the financial assets, then it will be effective OCI. In absence of fair value option, the entity can classify the fixed rate asset as fair value OCI with the gain and loss on changing in fair value are recognized in OCI. So we need to recognize in OCI, and fixed rate debentures at amortized cost. However, reporting both assets and liabilities as fair value, that is FETPL, correct the measurement inconsistency and produces more relevant information. So hence it may be appropriate to classify the entire group of fixed rate assets and fixed rate debentures at fair value to PNL. Next, other question. So financial liability measurement. How can we measure the financial liability? So here financial liability is measured at amortized cost or fair value changes. Fair value changes FETPL liability. So amortized cost means interest cost. So interest cost will be recognized by using the effect interest rates recorded in profit and loss account on periodical basis, or if it is a financial liability FETPL liabilities fair value is changing. So if that fair value is changing, if it is relating to unrealized gain or loss, it will be recorded in profit and loss account because own risk other than changing own risk. If it is relating to own risk, then it will be FET OCI if does not increase the mismatch, and it is realized gain upon derecognition. You need to recognize it in profit and loss on derecognition of PNL. Now 31st question. What is there in 31st question? A Limited, one company is there. A Limited is there and borrowing we taken from RBC. So it has borrowed some amount. How much amount they are borrowed? 10,000 rupees they are borrowed, and interest rate will be 10% will be the interest rate per annum. Loan processing fee were additionally paid for 500 rupees. So they are paid 500 rupees processing fee, and loan is payable after 5 years in bullet repayment of principal. So details are as follows. So loan amount will be 10,000. Date of sanction, date of loan, that is starting date will be 1st April 2001, and date of repayment of principal amount, that is finishing date will be 31st March 2006. So interest rate will be 10%. Interest to be charged and paid yearly, and upfront fee will be 500. How should the loan will be accounted in books of A? So who is the person who has taken the loan? That is A person. So here simply they are taking some loan 10,000 rupees and interest rate will be 10%, and upfront they are paying 500 rupees. You need to calculate the IRR rate, that is effective interest rate. Now so 1 year the amount 500 will it is the liability, and they are paying some processing fees. So it is integral part, we need to consider that integral part. So we need to deduct from the loan amount. So 10,000 minus 500, it will become 500. So for 500 we need to effective rate, we need to calculate on effective interest rate. So for that effective interest rate, we need to calculate the IRR rate. So IRR means what? Whatever the amount we are investing, the amount. So amount will be 9,500. For this 9,500, whatever the cash flows, if this cash flows is discounted with present value, the rate, this rate, then it must become the 9,500, then it is known as the IRR. So first we should complete that one. So we will test with 10% and we will test with 13%. So in 10% we will get 10,000, in 13% we will get 8,000. Whenever the discount rate is increasing, the present value will decrease. Here 10% means 10,000, 13% means 8,000. So but we need 9,500. So in this middle we have. So what we need to do here, NPV at 10% we need to see minus NPV value, that is 9,500 will be there now, 9,500 here, and here 10,000 minus divided by NPV at higher rate minus NPV at lower rate we need to see. So NPV at higher rate, it will be 10,000 minus 8,945 and into whatever the change. So change will be NPV load 13 minus 10. So we will calculate, we will get the percentage of 1.42, means we will add to this 10% plus 1.42. So we will get the percentage. So by that percentage we will calculate the interest. So here interest is calculated and the repayment amount will be on that interest rate we will calculate. So 9,500 will be there. So first year interest is calculated 1.42% and 11.42% repayment will be 1,000 rupees. They are paying every year. So for from 1 to 6 they are payable after 5 years bullet payments. So they are paying fixed interest 10% loan. So 10,000 for 10% interest after 5 years means, so totally it has 10 years. So 10 years means 10,000 divided by 10, it will become the 1,000 they are paying every year. Now every year they are paying means it is deducted, it is added. So for effective interest we will add back. So firstly this is A, this is B and this is C. So here closing will be get by A plus B minus C, will get the closing balance. After that we have that question number 32nd. What is there in question number 32nd? Issue of borrowing with fixed rate of interest. So now A Limited is there and another one bank is there. Same case, at fixed rate will be 12% per annum and loan processing fee or additionally 500 rupees and loan is payable for half yearly installments 2,500. So here they provided 2,500 each and at the starting they are collected 500 rupees and here they are provided loan amount and date of loan sanction, date of finishing date, repayment loan start from 30 September, installment amount will be 2,500, interest rate will be 12% and they are provided directly IRR rate. So if they are provided IRR rate, we need to consider that IRR rate only. If they are not provided IRR rate, we need to calculate that IRR rate. So in last question they are not provided that IRR rate, so we are calculated the IR rate. So if they are provided the IR rate, we need to consider that higher rate. So for quarterly they are providing 2,500, 2,500, 2,500, 2,500 4 terms and at starting time it will be 500. So this is amount which is the interest amount based on their percentage and this is interest based on the IRR rate. So which is calculated based on the IRR IRR rate. This interest will be based on IRR rate. For interest calculation on this amount we are calculating the interest amount and loan will be closing balance, this one. Next question number 33. I think question number 33. What is there in question number 33? X Limited is there. It has taken loan for 6 years loan they are taken from bank and paid processing fee. So processing fee at the time of sanction of loan. So term loan is disbursed in different tranches from April 2000 to April 2006. On the date of transition of India is 1/4/2005, it has calculated the NPV of term loan disbursed up to 31st March 2005 by using the effective interest rate, and proportionate processing fee has been adjusted in disbursed amount while calculating the NPV. So what will be the accounting treatment of processing fee belonging to undisputed term loans? So for the undisputed term loans we need to calculate them. So first, for that processing fee we need to see that is integral or non-integral. So if it is integral, then part of effective interest rate of financial instrument, and it should be included while calculating the effective interest rate. So accounting treatment will be accounting treatment in case future drawdown is probable. So it may be noted that to the extent there will be evidence, if it has evidence and it is probable evidence is there and that it is there, undisbursed term loan will be drawn down in future. So they have the evidence the loan will be undisbursed term loan in future, then the processing fee, whatever the processing fee for a transaction cost of under Ind AS 109, the fee is deferred and is deducted from the carrying value of financial liabilities when the drawdown occurs and consider it is effective interest rate calculations. So if the drawdown is not probable, then undisbursed term loan will be drawdown in future, then the fee is recognized as expenses in straight line basis. So if the drawdown is there, then the fee amount, whatever the fee amount, we will consider in the effective interest rate. If it is not have probability, then it will be recognized over a straight line basis over a term loan. Next question number 34th question. So in 34th question we have related to one company is there. So PQR company is there and it has taken loan from bank and bank A in 2001 and 2 and paid loan processing fee and commitment fee. So it has two fees, one processing fee and commitment fee. And in May 2005, PQR Limited has availed fresh loan from Bank B and takeover of facility. The loan he sanctioned to pay off the old loan takeover from the Bank A. So the company paid prepayment premium to Bank A to clear the old term loans and paid processing fee to new term loans. So they are changing the terms. So for changing the terms they are paying some fees. So where if you are paying any prepayment premium and processing fee, and both will be treated as transaction cost as per Ind AS 109 financial instrument for obtaining the new loans in the financial statement of PQR Limited. Now we will consider that accounting treatment of prepayment premium. Here Ind AS 109, we will see the Ind AS 109, that is financial instrument, provided that if there is any exchange debt instrument, so if there is one debt instrument and it has modification any terms, so they are modifying some terms in accounting for an extinguishment. So if it is become extinguishment, any cost or fees incurred or recognized as part of the gain or loss on the extinguishment in the statement of profit and loss account. So on the extinguishment related debt, one debt is there, on that debt is modification, it was become extinguishment, then it will be charged to profit and loss account. So since the original loan was prepaid, the prepayment would result in extinguishment of the original loan. Then whatever the difference between current value and financial liability, current value of that financial liability extinguished and consideration paid shall be recognized in profit and loss account as per Ind AS 109. Accordingly, the prepayment premium shall be recognized as part of gain or loss on extinguishment of old loan. Next, accounting treatment of unamortized processing fee of old loan. So processing fee are not amortized separately from the loan. So if it is unamortized processing fee, then processing fee is not amortized separately from the processing loan. Processing will part of EIR, that is effective interest rate, therefore are amortized with the loan. So it will be amortized with the loan sum. So if it is extinguishment is there, then prepayment premium will be shall recognized part of gain or loss extinguishment of old loans. And whereas in case of it is become unamortized processing fee, then it will not amortize it separately from the loan and it will be considered as effective interest rate. And accounting treatment of processing fee for new loans, so they are paying some processing fee for new loans also. Now for new loans they need to consider incremental cost that is attributable to acquisition or issue or disposal of financial assets or liability. And incremental cost is one that would not have been incurred if the entity has not occurred, so issued or not disposed. So it is assumed loan processing fee solely related to origination of new loans, so does not represent the loan modification or negotiation. So processing fee to avail fresh loan will be considered as transaction cost, so it will be treated as new loan and they are paying some processing cost, it will be considered as transaction cost. Next question number 35 questions. So 35 question here, one stock broking company is there. So stock broking company is there is dealing share or purchase of own account and therefore is having inventory of shares purchased by it for trading. How will this instrument be accounted for in the financial statements? So here India AS 2 is there. So India AS 2 inventory. India AS 2 inventory. Inventory means whatever the assets will be there, we will follow this India AS 2. So but except this financial instrument, India AS 2 is not applicable for this financial instruments. When financial instruments is there, then we should not consider this India AS 2. In inventory is said this standard applies to all inventory except this financial instruments. So for financial instruments India AS 2 is not applicable. For financial instrument we have 3 India AS. One is India AS 32, one is India AS 109 and one is another one is I think India AS 107, I think so. Yes, India AS 107. In 32 we will discuss about presentation. In 109 we will discuss about recognition. In 107 we will discuss about disclosure. So principles of recognition and measurement financial instruments governed by 107, presentation is governed by 32 and disclosure is governed by 107. So disclosures even in these instruments held as stock included by the company. And whereas 101 will talk about when companies is first time adoption of any India AS, then they have some exemptions and they will provide some exemptions and they will provide some benefits. So what is that exemptions or benefits? So at the time of first time adoption of India AS, so some cases they may continue with the old values only. So some cases they will calculate some costs, but this financial instrument need to be calculated retrospectively. So the transitional relief for the application of the above standard is not provided. So they will calculate the values retrospectively will be required. Next, difference between the measurement requirement of financial liability and equity and their comparison can be understood with the help of the following diagram. So if you have any contractual obligation to deliver the cash, so if you have any obligation, then it will become the liability. If do not have any contractual obligation to deliver the cash, then it may become equity. So then it will be carried at cost. So all transactions recorded directly in equity. Then if you have contractual obligation to deliver cash, then it will become liability. So for liability we have two options. One will be amortized cost, one will be fair value cost. Next, non-derivative contracts to deliver variable number of equity shares. So if you do not have any non-derivative contracts to deliver variable number of equity shares, if you have fixed number of equity shares, then variable number of shares it will become liability. Fixed number of shares it will become equity. So equity means it will be carried at cost, and liability means it has two options. It may go for the amortized cost or it may go for the fair value. If it is going for that, recorded income statement and impact in net profit or OCI based on the cases. And after that, reclassification of financial assets and financial liabilities. Here we will reclassifying the assets into financial liability. Here they will provide that amortized to FTL means firstly we are recognized in FTL, that is bond, means when you are invested in one bond, it will be investment means investment in account debit to whatever the amount. So here invested 1 lakh bond is there, and you are classifying to FVTPL. So if you are classifying to FVTPL now, bond at FTPL debit 10,000 and 90,000, and there is some loss is there on the date of reclassification. So retrospectively we need to adjust now. So we need to adjust that 10,000, and bond at the starting it was 1 lakh and now it was become 90,000. We will charge that 10,000 on loss on reclassification charger to profit and loss account. So amortized cost to FVT OCI. So AC to OCI. Now OC to ACI, that value is 10,000 and now 90,000. So amortize 10,000 FVT OCI, and loss will be transferred to OCI. When in PN FVT PL, it will charge you to PNL. FVT OCI, it will be charged to OCI cases. And FVT PL to amortized cost. So here 1 lakh will be credited bond, and where has amortized cost 90,000. Here loss on reclassification debited to 10,000. Next FVT OCI, FVT PL to FVT OCI. So here loss will be loss on reclassification transferred to FVT OCI only, and FVT OCI to amortized cost. So amortized cost it will also same based on the fund, and loss will be transferred to OCI, and amortized cost will become 1 lakh and bond at FVT OCI. So from which one to which one we are changing. So we have the investments we are changing now. So investments will be credited, and from which we are classifying it will be debited. Whatever the difference will be, some cases it will go for the PNL and some cases it will go for the OCI. For FVTPL and amortized cost it will go for the PNL, and other cases it will go for the OCI cases they are provided. And after that impairment. So some impairment related information, what is the approach will be there. Different approaches will be there for impairment: general approach and simplified approach, and purchased or originated credit impaired approach, and what is the 12-month expected credit. So it is also concept, good concept, expected credit loss and long-term expected credit loss. So we will do the some problems related to this one. So we have 3 stages now: stage 1, stage 2, stage 3. So firstly credit risk and expected credit loss model and interest recognition in stage 1 and stage 2 and stage 3. So initial recognition will be there, and significant increase in credit risk will be there, credit impaired will be there. In initial recognition the risk will be low. When credit risk is increasing, then risk will be high and credit impaired will be significant. This will be in case a credit loss. So expected credit loss model in 12 months expected credit loss, and in stage 2 it will be lifetime expected credit loss, and in stage 3 it will be expected credit loss will be on lifetime, and interest will be recognized. Interest on any gross carrying amount we need to recognize it. In carrying on gross amount any interest will be calculated and will be recognized. So for expected credit loss we will do some problems and we will close the class now. So first question will be 42nd question. In 42nd question they provided one company is there, a company is there, and they have one loan, 10 years loan will be there. It amount will be 1 million, and taking into consideration expecting here assuming one person is there, B person. Similar credit risk using reasonable and supportable information that is available without undue cost or efforts. The credit risk of the borrower and economic outlook for the next 12 months. So entity A estimates that the loan at initial recognition has a probability of default of 0.5%. So they are assuming that default will be there 0.5%, and next 12 months will be they are taking for 12 months, and entity A also determined that change in the 12 months that POD are reasonably approximate on the change in the lifetime POD for determining whether there has been significant increase in credit risk. If it is credit risk is increasing, initial recognition ROC given default LGD is estimated 25% balance outstanding. So on that balance outstanding it will be there. So total amount will be 1 million. 1 million means 10 lakhs. So 10 lakhs into 0.5 into 25% will be the amount expected credit loss allowance. So loss allowance will be 1250. And next approach, so 12 months expected credit loss. So first one will be 12 months expected credit loss, probability of default approach. Next 12 months credit loss rate approach. So second stage, here A is there and it has 2000 bullet loans and it will be 5 lakhs will be the carrying amount. Total gross carrying amount will be 5 lakhs. Bank A segment its portfolio into borrower group X and Y on the basis of shared credit risk characteristics at initial recognition. Group X compromises 1000 loans. So how many loans will be there? In X it has 1000 loans and with gross amount will be 200 will be gross amount, and group carrying 2 lakhs, and group Y will consisting another 1000 loans with gross carrying means for this 2000 X 1000 and Y 1000, and for 1000 X we will have gross value 2 lakhs, for 1000 Y we have 300, that is 3 lakhs will be the gross carrying value. There is no transaction cost of the loan conduct including no option prepayment premium or discounts points are paid or loss calculate loss rate when there are provided historical per annum average default present value observed. So it is historically, so past. Now we need to want now means by observing the market we need to arrive the rate. So firstly we need to take that amount, whatever the number of clients will be there, number of clients 2 persons X Y and 1000 and per client they are provided 200 300 and default will be provided already 2 lakhs and 3 lakhs. It is historical cost. So based on the books past experience they are provided historical rates. So we need new rate by observing the market. So for new rate we have expected the default will be this one, expected default 800 and 600, that is historical based. Now presently they are provided observing the market. Now this 600, so on this 600 divided by this amount, so 2 lakhs or 450 divided by 3 lakhs, then we will get the loss rate for year this year. Next question number 44th one, lifetime expected credit loss provision matrix. So here we will go with the provision matrix. So what they are provided, one company is there, M company is there, and it receivables will be 30 million will be the receivables and operates only in one geographical region. The customer base consists of a large number of small clients and trade receivables are categorized by common risk characteristics. So here company is paying all dues according to contractual terms. The trade receivables do not have significant financing component in accordance with Ind AS 115. In accordance with para, they provided a loss allowance for such trade receivables is always measured at amount equal to lifetime credit expected credit losses. So currently they are providing different time and different amount, it will become total 30 lakhs. For different period they have default rates were provided. So simply we are multiplying this time and this amount, based on we will get the amount. So percentage on this gross amount we will get the loss amount 5,80,000 expected credit loss. That is the this class.